Stick with me, folks, because I'm about to tell you a little story that will help you maximize your gains unlike anything else. It's a story about a bull, a bear, and a wise owl at a bar. A bull and a bear walk into a bar, arguing as usual after a long day at the stock market. The bull was boasting about the soaring market while the bear was grumbling about an impending crash. All night, the bull talked about the money he's going to make, how he's going to retire early, travel the world, and thanks to his soaring investments in gold and silver. And the bear just rolled his eyes and said, "You know what? You're going to end up broke when reality hits." The bull asked, "What reality?" The bear said, "That you take the stairs up slowly while I take Marcus down by jumping out the window." The bull laughed it off and said, "Oh, please, you're just bitter because you're missing out on all the gains." As they bickered, they noticed a wise owl perched on a stool, sipping a whiskey, laughing to himself. Curious, the bull said, "What's so funny, old timer?" The owl replied with a grin, "Oh, I'm just enjoying the show. You two are two sides of the same coin, one bullishly optimistic and the other bearish to a fault. You two are always at each other's throat, but you're missing the bigger picture." The bear frowned. "What do you mean? Surely you can see the market is going to collapse." "And you're blind if you can't see how much money we're all making," the bull replied. The owl hooted with laughter. In every market, there are bearish moments, my friends, and bullish moments. And that's where the real money is made. Confused, the bear and the bull looked at each other. The owl continued, "You see, during the bull market, there are always significant pullbacks. Smart investors use these moments to make even more money. It's like a roller coaster. The downs are just as important as the ups for an exciting ride." The bull scratched his head and said, "But I thought we were supposed to always be optimistic." The bear added, "And I thought we should always prepare for the worst." The owl smiled wisely. "Balance, my friends. It's all about balance. Embrace the bull's optimism, heed the bear's caution, but always be ready to act when others are frozen by fear or blinded by greed." As the bull and bear pondered this, the owl raised his glass. "Here's the pullbacks that keep us on our toes and the surges that keep us in the game. May we all learn to dance with the market instead of fighting against it." The bull and the bear clinked glasses with the owl, both a little wiser and a little more confused. But as they say in the world of investing, confusion is the beginning of wisdom. What is good, Stackers University? It's so good to have you here. I love this little story, especially after days like today, because it really drives home the point, some of the most important points that we need to hold on to during a bull market and some lessons that we need in order to be a successful investor, especially during a bull market. First, it's about balance. Bull markets don't just go straight up like we've experienced over the last few months. As we've discussed in previous videos, markets move in waves that ultimately stair step up, and pullbacks are just absolutely a part of the process. Part of the owl's wisdom comes from his understanding of how markets have historically performed. Specifically, we have surges followed by corrections. In reality, the hardest part of a bull market comes from riding the bull. In some ways, we are all like bull riders at the rodeo. As soon as the gate opens, the bull is doing everything it can to keep you from riding it to the end. The metaphorical commodity bull does the exact same thing. And the only way you can hang on is with your balance and counterbalancing the bull movements. When the bull bucks one way, you have to move the opposite direction. When the market drops, you have to go the other way and buy more. And when it goes up, you have to pull back on your buying and wait for a better buying opportunity, like what we're seeing recently. This leads me to lesson number 2. Understanding market cycles. The owl understands that markets move in these cycles, and ultimately, you can't ride a bull market with a bear mentality. This is actually the most challenging at the start of a bull market, which is where we are now. Why? Well, remember in behavioral finance how we talk about recency bias? Recency bias is the tendency for people to give more weight to more recent events or observations when making their decisions, even if these recent events are not representative of the long-term trend or the full range of possible outcomes. During bull markets with pullbacks, which can be vicious at times, recency bias can show up in a number of ways, like overreacting in the short term to the market, ignoring historical patterns, chasing recent performance, misinterpreting the overall trend, and overlooking buying opportunities. Take a look at this chart from Jeff Clark at thegoldadvisor.com, where he shows that during the last bull market from 2001 to 2011, there were 20 different times gold experienced a price correction from 6 to 27%, with the average pullback being 12%. That means during the bull markets, these are very normal price cycles, And instead of being shaken out of your position, those are actually your buying opportunities. They are intended to shake out the weak hands and amplify the profits for those that understand how the market moves. This is why you have to maintain a long term perspective, have a strategy, take advantage of dollar cost averaging opportunities, and most importantly, manage your emotions. If you can learn to embrace the cyclicality of these markets, then lesson number 3 becomes a piece of cake, which is embrace pullbacks as opportunities. You have to learn to be like the wise owl and those that see these bearish moments during a bull market as opportunities to buy assets for cheaper. This is why anytime you experience a 10% pullback in price, you should treat that as a buying opportunity. Again, not financial advice. As I just showed you though, from the previous slide, you need to be prepared for anywhere between a 15 to 20 of these moments where we have pullbacks that can range from 6 to 27%. And it does require an embodiment of lesson number 4, which is, and if you heard me say this once, I've said it 1,000 times. You as the investor are often the riskiest part of the investment. Or as Uncle Rick Rule says, the problem is often to the right of your left ear and to the left of your right ear. Of course, I'm talking about your ability to manage your emotions and your thinking. As I shared, the bull is constantly trying to buck you off. And instead of physical strength, staying on this bull requires mental strength and emotional resolve. Now, I wonder how many of you heard what I was just saying or how many of you missed it because you were watching the video on the right. I'm just shaking my head at y'all right now. All right, let me say this again. The bull wants to throw you off, but riding this bull isn't about physical strength. It's about emotional and mental strength. The market is simply going to do what the market does. So the problem and the opportunity both live inside you. Successful investors combine optimism with caution. Just like flipping a coin, the bear and the bull will have their moments. But as long as you're in a bull market and the fundamentals haven't changed, the challenge is managing yourself. When there's a pullback in price like we are experiencing now, do you have the emotional fortitude to suppress those negative emotions and buy more? That's the $1 million question. The last lesson I want to touch on, and really it pulls everything we've discussed together, and that's having a long-term perspective. The last lesson is what I just touched on and really pulls everything together that we've discussed thus far, and that's about this long-term perspective. That is what the owl is driving home for us, that in order to be successful, we have to have this patience. Let's be clear, when you have your balance and emotional control, the gyrations of the market are just that, gyrations, and they're buying opportunities. You can only know this when you understand market cycles, which includes having a strong investment thesis. There are times to be bearish and there are times to be bullish, but that's not because of price. Remember, price is a lagging indicator of success. If you find yourself waiting for price confirmation, you will already miss the big move or the buying opportunity from the bottom where the easy money is made. Instead of getting caught up in the social sentiment and the emotionality, remember to focus on the major drivers of the gold and silver market, specifically economic factors, inflation, deflation, interest rates, currency fluctuations, market sentiment and economic uncertainty, geopolitical tensions, supply and demand dynamics, government and central bank policies, speculation and investment trends. All of those things are a part of how you determine when it is time to get in or get out of the market. So don't allow the price to change or dictate how you feel about your investment. If those fundamentals are still there, we can experience short-term bearish moments all the way up to 27% as we saw in the previous bull market. So you got to stay strong. Focusing on these broad indicators will help you see not only where the market is, but where the market is going. This way you can approach and ride the bull market with a bullish mentality or risk just getting bucked off early. In the comment section, what's your biggest challenge when it comes to managing your emotions during market pullbacks? What's the most valuable lesson you've learned about investing in gold and silver during bull markets? What indicators do you find most helpful in determining if we're still in a bull market? Or simply put an A+ in the comments so that everyone knows that you always stack smarter and never stop learning.